Algo Index Market Close, Wednesday, the 22nd of July. Two things happened today that do not belong on the same afternoon. The two biggest companies in this entire index were set to report after the bell, the kind of night that usually shoves the whole market around, and the index answered by doing nothing at all. It finished 0.14% lower, at 7,499, inside the narrowest range in more than a week. Now the second thing. While that price sat frozen, the people who hedge this market for a living reversed about $11 billion of position, from long to short, in a single session. A quiet close and a violent repositioning on the same day. What reconciles them is one wall of dealer gamma parked on 7,500 that ate the whole move. The fear gauge helped it along, down 2.4% to 16.64. I am going to promise you one thing, and then spend the show paying it off. The single loudest options bet placed anywhere today was not a bet that stocks go up, and it was not a bet that they crash. It was somewhere most traders never looked, and once you see it, the whole defensive posture of this session snaps into focus. Stay for that. Start with the round trip, because it is the tell. The 5-minute record we keep shows price coming in near 7,497, sinking inside the opening minutes to a session low of 7,485.85, then working its way up until 12:35 in the afternoon, where it topped out at 7,525.94, before handing every gain back and settling at 7,499, 40 points out and 40 points home. The fear gauge closed at 16.64, lower by 2.4%, and its own volatility index eased to 95.55. Put activity ran heavy, roughly 3 puts traded for every 2 calls, with open interest sitting near 1 1/3 to 1. Implied volatility rank finished at 18, which is low, so options are cheap. The Nasdaq 100 held a touch positive into the close. Every one of those readings points the same way. A market marking time, buying downside quietly, waiting for a catalyst it knew was coming after 4 o'clock. This is the segment worth the whole broadcast, so I'm going to slow down on it. Real-time dealer hedging flow started the day at a positive $3 billion of delta. By the session low, it read minus $8 billion. That is roughly $11 billion of dealer delta sold inside a market that barely twitched. And the composition is the entire point. The move to minus $8 billion came from two things at once: longer-dated put buying and same-day call selling. Desks were paying up for protection that lasts past tonight and giving away the upside that expires today. That is a book being repositioned for defense in front of the two biggest earnings reports of the quarter. So why did the price not move? Because dealer gamma stayed positive for a second straight session, and it was concentrated right on 7,500. When $11 billion of delta is sold into that arrangement, the hedge absorbs the sale instead of chasing it. The stillness you saw was not the absence of activity. It was a very large sale being quietly eaten by the level it was sold on. The broader read agrees. Options flow in the major index funds was strongly bearish today, a collective bearish position near $6.8 billion, ranking in the 98th percentile of the last month, and it was dominated by put buying, even though overnight futures were pointing higher. And underneath it all, 1-month implied correlation is still stuck in the single digits. Inside the zone are read flags for volatility spasms. Low correlation is why the index can hold flat, while individual names, tonight, are free to gap 5% apart on their own earnings. The index was pinned, the single stocks were loaded. Walk the path against the levels, because the market obeyed them almost to the point. Before the bell, the line that mattered was 7,480, bullish above and bearish below. The open dipped to 7,485.85, about 5 points over that line, got bought immediately, and never revisited it. From there, it climbed into the volatility inflection level near 7,510, pushed to the high just past 7,525, ran into the first supply shelf, and reverted all afternoon back to the magnet. And the magnet is the cleanest number of the day. The highest probability strike our read had sitting nearest the close was 7,502, with a 95% tag. The computed pivot independently landed at 7,503. The index closed at 7,499. 3 separate methods, 1 price. Hold the arrangement in your head this way. 7,480 is the pivot everything hangs on. 7,500 is the pin. The nearest wall overhead is 7,530, and 7,600 sits above that. Here is the promise from the top. The biggest single options bet anywhere today was not on the stock market. It was on bonds. Roughly 212,000 contracts changed hands in a long-dated treasury call structure. 100 straight calls bought against 120 calls sold, expiring in January of 2028. That is not a hedge, and it is not a day trade. That is a wager, 18 months out, that long-term treasuries rally hard, which is the same thing as a bet that interest rates fall from here. It carried the most extreme options volatility demand on the entire board, the 100th percentile. And attention is the whole story. This bet was placed on the exact day the 10-year yield pushed to a 2-month high, with oil also at a 1-month high, both of them pressing the wrong way for stocks. So while equity desks were buying index puts and selling upside into earnings, somebody put down a very large, very patient bet that the rate side of all this eventually breaks lower. Bought to open, real conviction. It is flagged off the prior session's positioning, so we tag it as flagged, not stamped. 6 trades on the desk. 4 wins, 1 loss, 1 break-even. The honest split is worth telling, because it maps exactly onto the kind of day this was. The NASDAQ proxy strategy went 4 for 4. A pinned mean reverting session that keeps circling back to one number is the friendliest possible environment for a strategy that fades stretch and takes the reversion, and it took all 4. The automated index strategy had the harder day, 1 loss and 1 break-even, because a directional automated entry is the one thing this market punishes when price keeps snapping back to the middle. We are not going to dress that up. The read favored range trades, the range trades paid, and the one directional bot got caught. Same market, 2 different tools, 2 different results, and both of them are exactly what the environment should have produced. The bias is cautious and leans a little lower, and it hangs on 7,480. Defend that pivot, and this stays a pinned, reverting market. The magnet at 7,500, and the walls at 7,530 and 7,600 overhead. Surrender it into the close, and the read tips toward the 7,400 shelf. For context on how much room is above, the 52-week high sits at 7,621, about 1 6/10% up, and relative strength is nowhere near stretched. So this is not a market running out of runway. It is one waiting on news. A note on ourselves. Last night our read here was 2-sided, with the weight sitting on the downside, and it flagged that a market resting on its decision line would pin near 7,500 if that line held. It held. It pinned. We will take that read. But the real event is not tomorrow's opening bell. It already happened, after this one closed. A major chipmaker reports tomorrow, but the 2 names that decide the mood printed tonight, and both of them fell, one about 4%, the other about 3%. The market spent all day buying protection into that. If you want an honest scorecard on your own trading, our journal is free, and it does one thing well. Feed it one of your trades, and it grades that entry against the real quotes that we're printing in that exact minute, not the ones memory hands you. It is at members.algoindex.com/auth/signup. Every level I walk tonight gets graded in the open, whether the number makes us look good or not. And that public record is at algoindex.com/tools/gamma-level-accuracy. The written work is at algoindex.com/blog. And the community side runs on Discord, by invitation. One last thing. All day, this market did the boring thing on the screen and the serious thing underneath it. $11 billion of protection bought into 2 earnings reports that had not printed yet. Tonight, they printed, and they printed lower. The people who spent today buying insurance were not early for nothing. We will see who else was paying attention when the bell rings tomorrow.